So let's continue where the markets go from here. That conversation with Hank Smith, Chief Investment Officer at Haverford Investments, and still with us, our guest host, Jim Rogers, who is kindly munching away at his big breakfast spread. Hank, sorry you can't partake in that, but do tell us where you think markets are going to go from here, especially now that we're looking at a little bit more clarity in terms of tax policy.
Well, Nicole, I think the tax policy might have already been priced into the market, but not priced into the economy. This is a big relief for small business, and small business is the engine of job growth. Having said that, though, we think we're very optimistic about the markets because the fundamentals have stayed ahead of stock prices. In other words, earnings growth, which is really the engine of stock returns, have outpaced these very good returns so far this year. So we remain optimistic. We still think equities are, and particularly U.S. large cap equities, are one of the cheapest asset classes today. And on the other side, debt, particularly sovereign debt, is one of the most expensive asset classes.
Wow.
What do you think?
Hank, I happen to agree with that 100%. I'm even short United States government long bonds. But I'm surprised to hear people say that. So you really think all government debt around the world is overpriced? I happen to agree. I'm just a little startled.
Well, maybe not all sovereign debt, but certainly U.S. Treasuries are one of the most expensive asset classes there are. And all of this money, I mean, November 15th marked the first week in which, after 99 weeks, we finally had net outflows in bond funds. So we had 99 weeks of net inflows. Many of those investors are destined to be disappointed with the returns over the next 3 to 5 years.
No question about that. But now, how long will it take before interest rates are going higher, as you just pointed out? Eventually, that usually works through its way through the stock market, and stocks suffer.
Where do you think stocks are going, Jim? We have a question actually in from San Diego, talk about getting up early, from John, who wants to know, would you please tell CNBC viewers where you see the S&P 500 and the NASDAQ going between now and the end of the year, and do you see stocks higher in the first quarter of 2011?
Now and the end of the year? 3 weeks? I'm not smart enough for that. Watch CNBC.
They're antsy.
I'm not a good market
What about
timer. Hey, you tell me. Tell them what time. Where's the market going to be in the next 3 weeks? I don't know.
Higher.
Higher. Okay, so Hank says it's going to be higher. My way to play Hank and Nicole, although we really should be speaking to Hank, is I own commodities because if the world economy gets better, commodities are going to do well. If the world economy does not get better, they're going to print money, and then the commodities will do well. So either way, I would rather own commodities than stocks. I do own a few stocks. I'm short bonds, as I said, and I'm short a few emerging market stocks.
And what commodities? We have a lot of questions in about commodities for Jim. One from Francis, who just says, which commodities do you think have the best prospects?
Well,
Basic
first,
question.
I want to go back to Hank just for a minute because I don't think we're going to have him for long. So, Hank,
he's coming back.
Your view is, oh, he's coming back?
Yeah.
Well, your view is that stocks are the place to be, bonds should be avoided. Any other, do you own commodities? Do you own foreign currencies?
Well, we share a little bit more optimistic view than you do, Jim, but we do have a portion of the portfolio tied toward commodities and particularly exposure to emerging markets. We would rather own equities that represent underlying commodities. The experience of the last 3 years have shown us that when the markets collapsed, commodities gave you all the downside of every other risk asset. But off of the bottom, you've had a better return owning emerging market equities as opposed to the underlying commodity. So we prefer being equity investors.
And Hank, just go back to that point.
Well, just one correction on that. Yes, commodities did go down, but that was because AIG and Lehman Brothers went bankrupt, and there was a gigantic forced artificial liquidation of commodities because they were big commodity players, as you know. Same type of thing happened in 1987. You had big forced artificial liquidation of stocks for peculiar reasons, and then, stocks came back strongly, just as commodities have come back strongly from the AIG Lehman Brothers collapse.
One question I would have for Jim, though, is how much today are financial firms influencing commodities prices in the futures market, whereas 10 years ago and beyond, you really only had physical people with physical interest in commodities on the futures buying. But today you have many hedge funds and other financial firms in buying.
Well, there's no question, Hank. Whenever you have a bull market, it attracts capital. In the 80s and 90s, we had a bull market in stocks. Money went into stocks because that's where the bull market was. The question could be said, well, how much money in the 90s was coming from the financial community? Well, a lot of it. We had index funds developing. We had a lot mutual funds booming because that's where the bull market was. Whenever you have a real estate boom, money flows to real estate. If you have a tanker boom, money flows to tanker. Money's, clever. It goes where the returns are. So, yes, people are investing in commodities now because that's where the fundamentals are positive.
And what commodities?
Well, all commodities, first of all. But if I were buying commodities today, I'm more interested in agriculture than I am in other things. Gold is making all-time highs. I own gold.
Silver?
Don't get me wrong. I own silver. Silver's cheaper than gold.
Silver's still $30.
Yeah, I own silver, but I know it's $30, but its all-time high is $50. So it's still down 40% from its all-time high. So of those two, I'd rather buy silver than gold. I'm not buying either at the moment, but I'm certainly not selling. But back to the question, I think agriculture prices are still extremely depressed. Sugar is still down over 50% from its all-time high, even though it's gone up a lot recently.
I just want to go back to something.
Russ, he's riding around in a tractor.
Well, they're very comfortable these days, tractors, the super cabs. You get everything in there. I just want to go back to something that you raised, Jim, for Hank. Hank, how high do bond yields have to go before they become an impediment for stocks?
Well, first of all, I think right now you're just seeing a return to normalization as opposed to the depressed levels. A 2% 10-year Treasury really is forecasting deflation and maybe another recession, and we don't think we're going to get that. But I think stocks can behave well from a 3% 10-year Treasury on up to perhaps 5%. And again, it also depends on the duration that you're talking about. If yields jump dramatically in a very short period of time, I would agree that would not be good for the stock market.